Coming up on Market to Market, Pacific trading partners come to an agreement as China sits on the sidelines. The short-term outlook may be bleak, but the future may be beefier. And the supply and demand report creates even more volatility in the markets. Those stories and market analysis with Don Roose next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, October 9 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Stock markets around the world bounced back this week as the Federal Reserve Board held off raising interest rates. The Fed was expected to bump up interest rates late in the third quarter. However, according to notes released this week, poor job numbers squashed the idea. Despite uncertainty over when the Fed will raise interest rates, stock markets took the ball and ran with it as Wall Street rebounded from last week's losses. The price of oil gained some traction as Russia's military launched airstrikes in Syria. And according to the Commerce Department, the U.S. trade gap jumped sharply in August as exports fell to the lowest level in 3 years and imports rose to their highest level since March. An assault of sorts is underway on that trade gap. The member nations of the Trans-Pacific Partnership began meeting late last month in another attempt to reach some kind of agreement that would drop trade-blocking tariffs and open the door to a broader exchange of goods.
We, the trade ministers of Australia, Brunei Darussalam, Canada, Chile, Japan, Malaysia, Mexico, New Zealand, Peru, Singapore, the United States, and Vietnam, are pleased to announce that we have successfully concluded the Trans-Pacific Partnership negotiations.
After 5 years of discussion, the Obama administration hammered out an ambitious trade deal with 11 Pacific Rim nations early this week. Along with the U.S., the trade bloc will bind 40% of the world's economy into a new framework for commerce, and if adopted, could unleash $28 trillion in trade and investments for the countries involved. While trade disputes over dairy, automobile, and pharmaceutical markets stalled efforts in Hawaii this summer, this week's mulligan in Atlanta serves to beef up the president's foreign policy pivot to Asia.
This agreement makes us more competitive by eliminating about 18,000 tariffs that are placed on America's products in these other countries. Just to give you a couple examples, Japan puts a 38% tax on American beef before it ever reaches market. Malaysia currently puts a 30% tax on American auto parts. Under this agreement, all those foreign taxes will fall. Most of them will fall to zero.
Almost immediately, President Obama took on the arduous task of selling the deal domestically, speaking with businesses and agriculture leaders at the Department of Agriculture. According to USDA, Trans-Pacific Partnership countries alone already account for up to 42% of annual U.S. agricultural exports, valued at $63 billion. Of the $28 billion in corn, dairy, and pork alone traded to foreign markets in 2014, over half was purchased by TPP member nations.
Americans grow and manufacture a lot of top-notch goods, like cars, music, and bacon, that people across the world want to buy. And that's important for our economy because 95% of the world's consumers live outside our borders.
Several labor groups expressed concerns that American jobs could follow exported goods to foreign shores. But the White House claims the groundbreaking accord encompasses the strongest labor standards of any trade agreement in history. In response, AFL-CIO President Richard Trumka issued the following statement. We ask the administration to release the text immediately and urge legislators to exercise caution in evaluating the TPP. As we've said, rushing through a bad deal will not bring economic stability to working families, nor will it bring confidence that our priorities count as much as those of global corporations. Farm groups have pushed to eliminate trade barriers on exports ranging from meat and poultry to grains and cotton. However, the National Farmers Union remained critical of the accord because it lacks language to limit foreign exchange market intervention, saying gains that may have been made in the agreement to ensure fairness and equity in trade for America's family farmers and ranchers are likely to be lost due to currency manipulation. Any deal that lacks tough language against currency manipulation is not worth the paper it's written on.
Let me be very clear. It is not designed to encircle China. To the contrary.
Asia's largest economy also casts its shadow across the Trans-Pacific Partnership. The arrangement excludes China, which has routinely dismissed the multinational pact as an effort to contain its economic influence. But fierce opposition seems to have given way to a wait-and-see approach. The communist nation recently hinted it may be willing to join TPP in the not-too-distant future. No matter how the agreement plays out, China remains a big player in the U.S. agricultural trade economy. Last month, more than a dozen Chinese buyers agreed to purchase a record-setting $5.3 billion of U.S. soybeans at a contract signing ceremony in Iowa. The 484 million bushel order comes just before harvest of an anticipated record crop.
When you talk about China, you talk about big things. So they are a big pork producer, they're a big chicken producer. So, soybean meal is a very important ingredient in feed for all of those animals, and that spells good things for U.S. soybean growers.
It will be several weeks before the full scope of TPP is known. By law, the president cannot sign the agreement for 90 days. And the White House said it will need backing from both sides of the aisle to get the deal through Congress. But lawmakers aren't expected to vote on the trade agreement until next year, providing unions the chance to maximize leverage with politicians who covet their support. TPP will be among the many issues affecting agriculture in the coming months. A case in point is the skirmish over a new Environmental Protection Agency rule governing the waters of the United States. The controversial mandate has been viewed by some as governmental overreach. In August, a North Dakota federal court put a stop to the measure in 13 states. On Friday, a federal appeals court put the regulation on hold, effectively blocking implementation across the country. While the details of these issues are sorted out, a more immediate concern for rural America is the health of its economy. And those who are tasked with bringing that future into clearer view took another look this week. Paul Yeager explains.
A declining energy and agriculture sector have pulled down the Midwestern economy, according to one academic who tracks the region's financial health. For the second straight month, the MidAmerica Business Conditions Index dipped below growth neutral, according to Creighton University's Ernie Goss. The monthly status report cited lower employment, wholesale inflation, and a stronger U.S. dollar as factors, putting downward pressure on the economy. The 9 states covered in the survey show the region lost almost 1%, or nearly 15,000 jobs in the last 12 months.
What we're seeing is the manufacturing sector, particularly the manufacturing sector either linked to agriculture, energy, or exports, or in some cases, 2 of the 3. Those areas are having a real tough time of it.
The Fed's delay on a short-term interest rate increase, according to Goss, is seen as a negative sign for the domestic agricultural industry looking to expand export markets. And the higher dollar makes U.S. goods more expensive, forcing America's trading partners to search elsewhere in the world for the same products.
And that affects us in many ways. In other words, it's the equipment dealer in these rural communities having a tougher go of it. But then you go back to the producer, that would be the John Deeres, the Klaus, the Caterpillar. They're having a much tougher go of it. Then if you go back a step from that, the metal producers that produce metal for the John Deeres, the Klauses, and the Caterpillars.
Many producers maintain both a grain and livestock operation to help guard against boom and bust cycles. However, the double-barrel decline is making more than one farmer worry about the future.
It is a difficult time out there, but again, the farmers are conservative. in terms of their own personal fiscal policies. They've got pretty good cash balances. They'll do well through this. 2016 is looking to be much better in terms of all farm income. Energy prices, we've got to still wait and see on that one. That one's a little tougher.
And the energy boom that helped boost the economies of Oklahoma and North Dakota has become their Achilles heel. Oil futures selling under $50 a barrel have forced cutbacks in those regions. Goss believes as many as 5,000 jobs could be shed in North Dakota alone in the fourth quarter of 2015 as companies look to weather the storm.
North Dakota is one of the few states in the nation that did not enter the recession, and now we're seeing it's not a recession, still not a recession, but it's feeling like that for a lot of sectors in North Dakota and Oklahoma, another state that we survey. I'm still bearish on oil, bullish on agriculture once we get into 2016.
And that could include a rebound in the cattle market, which has struggled in recent weeks. Producers have seen a drop of more than 20% over the last 3 months and a 30% fall over the last 12. Feeders haven't fared much better. After topping out at $235 in December of 2014, the sector has plummeted 21% since then.
We look at the last couple of years, 14 we saw record high cow-calf returns. There's still thoughts we'll see those here in 15, but I think there's still signals for continued expansion at this point. Yeah, we've had some fallout there in prices a lot faster than we had initially anticipated, but I think things just all came all at once here.
Kate Brooks, a livestock economist at the University of Nebraska-Lincoln, sees a lot of macroeconomics causing the price decline, but also acknowledges some microeconomics are in play as many heavy feeders are being run through the system.
We can't just think locally, we've got to think globally as we think through all this process. In the short term, some of those local things do come into factor. Cow-calf producers, I think cost is going to be a big player as we move forward, and as we see these lower prices, the low-cost producer is the one that's going to be able to still benefit even if we're not at record high prices.
While Brooks and Goss realize they are painting a bleak picture of the marketplace in the immediate future, many wonder if there is any room for an optimistic outlook of agriculture in the long term.
Our economy, I sometimes say, is the healthiest horse in the glue factory. It's not a return to the 80s. I don't see that at all. Since 2009, we've had very good farm income. Now, 2014 farm income was down from 13. 15 is going to be down from 14. Now, I think 2016 is going to be up. A lot will depend on what happens in Congress. We need approval on these trade pacts. We need to see our global trading partners, their economies improving. Right now, during an election year, American voters are just not that supportive of trade, and for an economist, that's the oddest thing. A trade is very good for the economy. It's not very good for voting, though.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
The USDA supply and demand report put some volatility into an already harvest-heavy grain market. For the week, December wheat lost 4 cents as the nearby corn contract fell nearly 7 cents. Cuts in the supply and demand report of nearly 60 million bushels pushed the November soybean contract almost 12 cents higher. December meal prices kept the pace, gaining $5.70 per ton. In the softs, December cotton gained back last week's loss, rising $1.47 per hundredweight. Over in the dairy parlor, October Class 3 milk futures gained 11 cents. The livestock sector rallied after last week's losses. The December cattle contract rose nearly $6. November feeders gained over $10 per hundred, and the October lean hog contract stayed with the trend, gaining 75 cents. In the currency markets, the U.S. dollar index lost just over 1%. November crude traded $4.09 higher per barrel. COMEX gold gained $19.30 per ounce, and the Goldman Sachs Commodity Index gained more than 22 points to settle at 381.50. Here now to lend us his insight on these and other trends is one of our regular market analysts, Don Roose. Don, welcome back.
Thank you, Mike.
We had the World Agriculture Supply and Demand estimates out today, and I want to talk about the wheat market first and looking at the global picture. We saw global carryout raised another 2 million metric tons. Where does that put the U.S. producer in the picture?
Well, I think when you look at the report overall, it still continues on the wheat, a supply bearish market yet. There's no doubt about it. The wheat market's had a 70-cent rally from its bottom in just short order, went up to some very tough resistance. But like you said, the production on this report was lowered, like 84 million bushels. But when you look at the global ending stocks, that's the real issue, is up again, 2 million metric tons. We're 670 million bushels more wheat on our ending stocks than we had a year ago. That's a lot of wheat. And, you know, in this report, the trade thought maybe we've had issues with Australia. That's part of the reason that the market went up. And in this report, surprisingly, the government actually increased the production in Australia 1 million metric tons, in the EU 1 million metric tons, and in Canada 1 million metric tons. So still a lot of wheat out there, Mike.
So looking out at Australia, at India, at some of these other wheat producers, apparently USDA isn't anticipating El Nino to have much of an effect on their production.
Well, you know, usually El Nino does have a big effect on Australia. You know, that's one of the areas you're in a drought, and they've been dry. But I think what the government's saying is it's too far along, so their crop is pretty well made by the time we had the issues. So I think that's what they're really saying. But, you know, what we really did is we've moved up to some very tough resistance areas, Mike. You know, we think this 520, 530 on December wheat is a tough area to get through. Even when you look at new crop wheat, July of 16, 525, 550, and even 17, you get up around 550. Those are areas that probably have to be considered as selling opportunities across the board.
Now today, as we sit on Friday evening, wheat closed 509, 10 cents under that tough resistance. Do you sell here, or do you think we'll have something to push us back into that resistance level?
Well, we think this was the rally, and on Friday, you know, just like you alluded to, technically we did break down on the front end of the wheat. So I think what we're going to see is early next week, do we get some more technical pressure to push us to the downside? You know, corn had a very poor close also on Friday, so, you know, the wall cracking a little bit on the positive. The technicals have been positive, but at the end of the week, they cracked.
Okay. Now let's talk soybean markets. You mentioned wheat had a poor close, corn had a poor close. Soybeans, not a terrible close. Talk to us a little bit about what we saw there in the soybean market this week, particularly after the report.
Yeah, the soybean market really has held together, and surprisingly, after the report, we saw the market, you know, pop up 15 cents, closed up about 4 cents. But, you know, from a overall supply-demand balance table, we still have a carryout 425 million bushels. You know, that's not a positive carryout. The government took the exports down 50 million, you know, and probably exports are still 50 to 100 million too high. And probably the yield could go up from the 47.2 up to 47.5, 47.6. So, you know, bigger supplies could be ahead of us. 9 out of the last 15 years, we have increased the yield from the October to the final, so it's very possible. Yields so far are just very stellar out here, Mike. So, but this soybean market, I think really where we're at is with a lot of these markets, they're so low, they're low enough that the producer's just not selling. So we have an artificially tighter situation than we normally would. So that's really the positive story, is the lack of selling, and watch South America weather.
And from the producer's perspective, as I've been talking to farmers over the last 2 weeks especially, we saw this price make a run at $9 repeatedly, and it breaks down at $8.96, $8.97, $8.95. Is that heavy commercial selling coming in and just pounding this thing right back down? Any chance we can get over 9?
Well, and I think that's the story. I think what we're going to, in a lot of these markets, I think that's where we're at. We've got enough supplies. This isn't last year. Last year, remember, we were very tight. We were trying to record tight supplies. We were trying to rebuild the pipeline. We had inverted markets. Bases were tight. It's just the opposite. Double ending stocks this year, double again next year. So I think what you have is when the market, it's like musical chairs. We pop up to the top side. Who's going to sell it? There's enough grain out there. So which producer is going to beat the other to the selling opportunity? So I guess what I'm really looking at is telling you is from January beans, 9 to 9.20 is probably a rough area to get over. On the downside, producers just shut the door when it gets down close to 8.40, 8.50, 8.60 on the board. So I think we're kind of in that trading range, and then we'll see if South America has some issues. It's been a little dry in northern Brazil as they're planting, but so far not a big issue.
All right, well, let's talk the corn market. We've got yield reports from everywhere that are all over the board. Where do you see this corn market headed?
Well, I think what we did is we kind of put to rest, what are the yields, what are the acres going to be, because the October report kind of settles a lot of that, and so we settled it. The harvested acres down 400,000. The yield is stronger than people probably thought, went up a half a bushel on this, 168 bushels. You got to respect that yield. They've got 86% of the test plots by the USDA harvested, so that one should not change a lot. It could even get a little bit bigger. But that's a number that you're going to have to say is pretty solid. So the corn market, we're 170 million bushels under a year ago on our ending stocks, but still our ending stocks are very adequate. Our exports are probably too high by 50 to 100 million. So you could see, opposite of last year, ending stocks go up a little bit from here forward. And it's the same thing as the soybeans. The producer, a lot of storage out here. The producers shut the door at some point in time on rallies. It's going to be the same thing. You're going to see selling as you need funds, and that pushes us back to the downside. You need a weather problem again someplace around the world to push us up, or stronger exports, which we don't see.
Okay, so do you see corn over 4 before January 1?
Well, I think when you get up to this 4 to 410, it's just going to be a tough struggle. But for the producer, if you look at the carries in the market, and that's what you should be looking at, is we have a 23-cent carry to July. You talk about couldn't we get to $4? Well, we were almost to $4.20 this year in July, or this last week in July. So you should try and use some strategies to take advantage of the storage. Don't let that the storage lose money for you. So lock in some kind of a carry, and there's some things you can do out there to improve on the overall price.
Okay. Now let's jump down into livestock markets. Finally, a positive week to talk about. Here on the cattle side, we saw live cattle up almost $6. What drove it this week?
I think it's the thing that's really caused the problem to start with. We just had heavyweight cattle. Guys were sitting on cattle too long. They got too big. The packer really ended up with the leverage, and so just pushed the market down. We had beef moved very slow, couldn't move the beef, too much beef coming at us. Then what really happened is the heavyweight cattle, the last 3.5 weeks, we've been busy flushing that out. The box beef moved lower. At one time we moved down 18 days in a row on box beef. So we finally reached a level around this 204, 205 that we're clearing out the beef. So we've got some good news. We're clearing out the beef. Beef's moving. The heavyweight cattle are sort of behind us to the certain degree. So now we're going to find out what the real cattle market is worth. And this last week, October broke down to 120, rallied up $11, settled pretty strong, 4 days in a row up. So, we're back to trying to find out what the real value is.
The bottom in here in this live cattle market?
Well, we think it is. We think that was the low, but we still have to deal with the cycle high that we put in 2014, which means more numbers are going to be coming at us next year. So if you really look at it, probably the fourth quarter, you're probably stuck in this cash market, 130, 135, maybe 140. And I think what you're looking at next year, probably a range on cattle, 120 if things, don't work out, too big a numbers coming at us too quick like we just had, and probably 150 to the upside, much different than those top ends. But I think, you kind of have to start to work with risk management within those parameters.
Certainly, and 120 to 150 or 130 to 150, much better than 117 to 125 like we saw in the last week for producers.
Yeah, that's exactly right. And the feed value we think is going to stay low here for the next year. Possibly that can change. So that's one item that you really can put to bed here for right now.
All right, now you talk about these larger numbers coming at us in this next year. We're seeing herd expansion, we're seeing growth here. And we've got a question from one of our Facebook followers. This is from Claire up in Spirit Lake, Iowa. And Claire's wondering what would be the best time this fall for placing new feeder calves in the feed yard. Where do you see feeders headed?
Well, I think the feeder cattle are probably bottomed, so probably last week was your best shot,
Right.
But I think from a price standpoint, the feeders on the cash didn't come down as strong as they should have, really. So it just tells you, it's tough, but I think that's what you're looking at. You can still do some risk management out in those deferreds. I think the one thing we've learned on this break, there's still big premiums out in those deferred months. You have February cattle get pretty close to 140 this week even. So you can still lock in some premiums in this market and make sure you don't forget to do that. In this last 3 weeks was a good lesson why you do use risk management.
And looking out for the end of this, through this fourth quarter, feeders probably going to rebound a little bit before we get to spring calves for those looking to place calves in the lot? Maybe get them bought sooner rather than later?
I think I'd get them bought sooner rather than later, because I think probably what you have is this was that big flush to the downside. It was the, the panic. We've seen this just a few times over history. This was one of the biggest breaks, one of the biggest panic situations we've had in history, actually, Mike, not counting the BSE years. So
sure.
It was a real debacle. And those are the times that you can, try and take advantage of them if you're in that position.
Challenges are opportunities if you're prepared in some cases. Now let's talk the hog market. We saw a little bit of a rebound this year, still staying very strong. Where do you see pork head in the next week or 10 days?
Well, the hog market has been an overachiever, and it hasn't because of the supply. It's really because of the demand. The demand has been just terrific. The pork cutout has been very strong. The thing you have to watch out for the hog market is we've got big supplies coming at us the fourth quarter. We think the weights are going to continue to grow. We now have beef down at a level that it really is tough to compete with. So, that's what you have to watch out for the pork. And, the government on Friday, they really gave us a big range that was quite low compared to where we're at on the board. They have us 62 to 72 dressed all of next year. So if you believe that, you would say that we're overvalued on the board and you should do some risk management. I'm not sure I believe all those numbers, but that's what they have. Pork production is going to be up 1.3% next year.
So looking at risk management, are you just holding off on risk management today, or are you actually actively getting out there?
No, I think when the government has these kind of prices, when you look at production going up, when you have profitability all the way out into next fall, I think you definitely take advantage of the opportunity that you have now.
All right. Well, Don Roose, thank you for joining us this week.
Thank you, Mike.
That wraps up this edition of Market to Market. But Don and I will continue our discussion and answer some of your questions in the Market Plus segment available on our website. It's also the place you'll find audio podcasts and streaming video of the program. Now, once you land on our homepage, look for information on Market to Market Classroom. That's our exclusive service connecting teachers and students to our stories about the science, technology, and business of agriculture. Click on the link and take a look. And join us again next time when we'll follow the creation of a tribute to the man credited with saving more than 1 billion lives. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.